Okay, yeah. First HoldCo Plc half year 2026 results. So we are going to look at first HoldCo half year 2026 results. So first of all, we look at the technical chart. Currently, this is what price has done, trading over 110 naira as at the time of recording, starting off from the low of close to 25 naira because it was renamed into a holding company. If not, you could have seen the extreme lower price. So this is the current chart. So let's go to the cash flow statement. So you can always, okay, sorry, let's read the headline. Sorry. So on our X page, let's read the headline, then we'll now dive into these graphics. Remember, you can always download these graphics on our X page, Apest on analysis, so it can help you. So as it's loading off, we now look at the headline, look at the graphics, and then tell you number facts behind the figures you are seeing and what has happened. So first HoldCo, then you see that profits PBT, profit before tax, grew over 83.5% year on year too. We have profits before tax of over 653.5 billion. Then profit after tax grew to the rate at the tune of 81.6%. That's in naira times it became 556.1 billion. So the storyline reads that the headline and the income statements underlying drivers are telling two different stories. So we now dive into it. You can always read up. So structured by corporates, this. So let's go to the graphics and explain. So this is the cash flow. So year on year, which is 6 months. So 6 months data, the free cash flow. There is now a free cash flow of roughly 458.4 billion as against last year, which was a negative 1.1 trillion. 1.1 trillion plus. So there's that a free cash flow. So that is it. So when we annualize, we are getting some number which we used for our valuation. So you can always annualize. There are different ways to annualize these numbers, but just know that there was a positive free cash flow. So let's look at the income statement side of things. Okay, so this is the income statement like we have been explaining. So if you look at the income statement, you can see Q2 2026, Q2 2025, and these are the changes. So you see that interest income was higher in 2025 compared to 2026. So banks make money through two different ways: the interest income, which is their lending business, and non-interest income, which can be a whole other things ranging from trading, fees, commission, and stuff like that. But the core business of the bank is actually centered on interest income, which is lending. That is what bank does: borrowing and lending. That is the core business of a bank. So that is why the two metrics to always watch out for in a bank book is the interest income and non-interest income side of it. So if you compare to 2025, so there was a negative drop in the interest income. Then that is why if you look at the net interest income, which is when you subtract your interest expenses from your interest income, so there was a drop of 18.5%. So this means that the core business of the bank has declined. They do make much money from lending, even though they made more profit, because you now need to understand where the profit is coming from. So you can put this, some people flag it, some analysts flag this, that why is the core business of the bank declining. Then another segment to now look at for is that non-interest income side of the business. If you look at the non-interest side of the business, you see the likes of your net fees and commission, your FS loss or gain. You see your, if there is a revaluation, there's what you call net gain from investment security. There is what you also call fair value, trading profit and loss, stuff like that. These are non-interest income. And if you look at them, all of them, they grew. Even FS turned positive. So this business made more money from the net non-interest income side compared to the interest side of the business. So that is why, despite the lower interest income, we still had a higher profit before tax. So the non-interest side of the business, especially from the fees and commissions, from the net gain that was coming from the fair value of their trading positions, gave them that edge. So they made so much money from that. So that's one arm of the business. So we still talk about that, but that's what we want you to pay attention to. So then you see when tax was deducted and stuff like that. So profit for the year was now closing in over this amount. Then you can see profit before tax and profit after tax. Then you look at the key ratios. So there's what you call the net interest margin ratio, which is the core one, but there is a proxy for it, which we call the spread proxy. So it dropped, which signal that net interest income is declining. But the cost side of business got better. When you compare the cost to the revenue, is getting better. Then cost to risk also getting better in terms of impairments. So there was no much impairment as compared to previous periods. So there was a period where there was so much impairment to be made. That's why if you look at the impairment losses, it is now declining from 148 billion as last it's now 75. So it is a positive that is declining. So these are what some of these metrics where then you can see the efficiency and stuff like that. You can always look it up. Then for the balance sheet, this is the balance sheet. So of course the total the assets of the business grew more by over 12%. So the assets now is sitting over 30.65 trillion. That is the balance sheet size of the assets. Then you can look at the liability. So the liability also grew to over 12.8%. Then the equity of the business grew over 9.9%. So there is significant growth in those things. Then if you look at the key metrics to always overlay this, then you can get a sense of what it looks like. Example, you can look at the equity to the asset side. You use some of these methods, just use it to convert and say use that as return on assets. You look at return on equity and stuff like that. So pretty mixed and stuff like that. Then loan to total assets, those things. You're just free to play around these things. Then finally, on the we have talked about the cash flow statement. So these are some of the things you need to know about First Bank. So the numbers first behind the numbers. Number one, on revenue, we say that revenue growth was a blend with operation in the core banking, which is the net income side of things. It failed, but fees and commission grew over 28.7%. So also trading gains also swung close to over 119.5 billion, and security sales. So they sold some of their securities they were holding. Also, they generated over close to 53.2 billion from that also. Then from the segment side of the business had different segments, but the best performing segment is the commercial banking. It is the best performing, followed by the investment banking and asset management. That is it. Then on geography wise, they are not really spread out there. Most of their money was made in Nigeria, Why their non-Nigeria, outside Nigeria revenue is almost flat at the tune of minus 0.6%. So it is a Nigerian story. Then from the balance sheet side of things, if you look at the AMCON fee is rising, is natural. The AMCON fee is you pay a percent of your total assets. So it rose close to 4. So the bigger you get, the more your AMCON fee is. But you rather grow and pay more AMCON fee than not growing. So it's 0.05% of the total assets. So if you don't know what AMCON is simply an Asset Management Corporation of Nigeria. So that's the fee they pay in case there is a distress, they come to the rescue. And another thing is that they did some diversification, like selling off. So they sold up to they had 100% stake in Senegal First FBN, that's First Bank of Senegal. So then they partially sold 10%. So they are remaining stake in First Bank in Senegal. So let me get out of the way. This Senegal branch now, they only now have 90% stake. So they sold off a little bit. And now there was also a private placement which was done from March to 26th, from March to June this year, when an additional over 1.02 billion units of shares were issued as 44 naira 6 kobo. So it's helped to raise fresh equity, even though the downside of the argument is that it led to dilution. It leads to earnings per share dilution, because there is now more outstanding shares in the market, net lowering the earnings. But it helped to raise fresh equity. So that is it about First Bank. So just know the key stories, not just reading up and seeing that they made such a profit. You need to dive into the numbers which we have explained. So you read up some of the things we said, we wrote about it, comment, like, share, watch on X, YouTube, and stuff like that, as we are fully in any season. So you'll be getting this handy and full breakdown like you can never see anywhere. So we break it down for you so you understand what is happening in the market. So see you in the next one. US and the global stocks, will break it down. So, but it happens to be an earning season for both the likes of Google, the likes of Unilever, all those stuffs. You always search, like we say, if you want to any of our research, you just come to the profile. You come to the profile. I hope it loads. If you come to the profile, you do a quick X search. There's a search icon somewhere here as it's loading. You type the ticker of the stock you are looking for or the name. If you have covered it, you will see the earnings, latest earning or the old ones, and you run along with it. Yeah, this is where you did the search. So provided we have covered it, you'll be able to get it. You just type it in here. So it must come to the profile first, then you do the search. So that's it. See you on the next one.